In January 2017, the ringgit's performance was at its lowest point in 18 years. For those born after Y2K, this was the worst that they've seen from our currency in their lifetime, and it continued to get worse when the value of the ringgit breached 4 ringgit 50 cent to the US dollar last month, a stark contrast to the 2 ringgit 99 cent to the dollar we enjoyed in the middle of 2013. What went wrong? A lot of fingers point at the discrepancies and questions surrounding our foreign wealth fund, One Malaysia Development Berhad. But is that oversimplifying things? In this two-part Quickiepedia, we look at the fundamental factors that decide the ringgit's rate. Okay, let's forget about the existence of 1MDB for a moment and ask why this happens. The first thing that will decide the ringgit's trend is investor confidence in how resilient a country's economy is and how well it can survive the shock of a sudden economic crisis, if it can at all. A nation's tolerance for disturbances and crises are determined for the most part by two main things: foreign exchange reserve and short-term external debt. Foreign exchange reserves are stockpiles of money held by the central bank which a country can reach into during times of crisis to deal with unexpected shocks and to service short-term external debt, like how you may occasionally have to dip into your savings account to pay your credit card bill. Don't worry, we've all been there, you're not alone on this. This isn't necessarily cold hard cash. It includes, but is not limited to, gold reserve, bonds, securities, and more. And now we come to short-term external debt. Short-term external debt is what it says on the tin, the country's credit card bill. Debt that it has to settle quickly to avoid default. One of the metrics that goes into determining investor confidence of a country is the ratio of a country's foreign exchange reserve to its short-term external debt. This year, Malaysians' foreign exchange reserves are at 108.91 billion US dollars. Yeah, that sounds like a lot of money, but what about the short-term external debt? Remember, reserves are only half the story. Malaysians' short-term external debt sits at 132.18 billion US dollars, meaning that in the event of a financial crisis and we blow all our foreign exchange reserves on settling our short-term external debt, we would still be short of 23.27 billion US dollars. And you thought your credit card bill was bad? Now, how do we stack up against the rest of the region? Let's take a look at three neighboring countries. Thailand's got 163.3 billion US dollars in their reserves, while they owe 67.16 billion. Downstairs in Indonesia, they're hoarding 134.39 billion and have to pay up 57.94 billion. The Philippines holds on to 86.51 billion and their debt stands at just 21.54 billion. Now, if we stretch the time frame a bit more, you'll see where the cause of concern started to show. The plunge started in 2013 when our foreign exchange reserves entered into a sharp decline compared to the foreign exchange reserves of Indonesia, Thailand, and the Philippines. Today, our foreign currency exchange reserves are more than the Philippines, but that gap is slowly shrinking. Rewind further to 2008, we've only been able to perk up our foreign reserves by a mere 19% since then. That's a stark difference to Indonesia, which has increased by 160%, and the Philippines by 130%. Thailand was also able to grow their reserves, and they did it by 47%. Moving on to the short-term external debt, Malaysia's short-term debt shot up by 296% over the last 9 years. That's almost triple of where it was. Again, comparing to our regional peers, just like how our parents used to compare us to other kids in high school, Indonesia, the Philippines, and Thailand had better control over their debt and managed to prevent it from doubling, seeing how it grew by 96%, 52%, and 49% respectively. A tiny increase in reserves combined with a debt that almost tripled in the last decade gave reasons for investors to see Malaysia as a risky country and thus likely to dispose of the ringgit, causing its value to take a hit. While lower international reserves and high short-term external debt may drive away investors, it attracts currency speculators. Currency speculation increases the volatility of the currency and, in turn, chances for these speculators to make quick and easy profits. Now, investors are concerned about debt, and that's where 1MDB comes in. The concern is that Putrajaya will need to bear the company's massive debts, and whether they can be paid off on time, it adds to our financial risk. So here are some of the major factors that determine the value of the ringgit. But wait, there's more! Check out part 2 of this Quickiepedia to see what happens outside of Malaysia that also messes around with the value of the ringgit. Till next time, I'm Daniel Anthony. Thanks for watching.